You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back to the Learn Like a CPA show. Today we're going to be taking some Q&A centered around real estate taxation. So I'm just going to go through a couple of questions that I received over the last few weeks, and I'm actually going to outline them and detail them with my iPad here today. So the first question says, can you talk about the difference between fix and flipping real estate versus buy and hold real estate and how it pertains to taxes? So awesome question, and I do have a podcast episode coming out about this soon too. So let's get into it. So if you look on the iPad here, on the left we're going to have the fix and flip. And on the right we're going to have the buy and hold. Okay. So the main difference here, what we have to think about is the fix and flip is income. Okay, remember that. The buy and hold is equity, wealth. What do I mean by that? Well, let's say both examples, we're going to have a purchase price of $150K. And the rehab is going to be, we'll say $50K for both. And the appraisal, let's say, is $300. So the appraisal is $300. So we have a $100,000 ascension to wealth for both people, right? Both people took $150K plus $50K, and now they have a house that's worth $300K. Well, what's going to happen? So the fix and flip guy, he's going to sell this, right? That's what he does. So he's going to do $300,000 minus $200,000. It's going to be the purchase price that he had plus the rehab costs for a total gain of $100K. Okay, and the buy and hold guy is going to have the same thing. He puts in $150K, rehab cost of $50. Now it's worth $300. But here's where the magic happens. Okay, this fix and flip guy, he has to sell this property. Okay, so first off, he doesn't have the property anymore. There's nothing there to help him build wealth or assets or anything. He sold the property. Also, he's got a tax bill. Anytime you have income realization, you have a tax bill. So he's going to be paying taxes on $100K, and let's just say he's in a 35% tax bracket, right? He's going to be paying $35,000 on this $100K, okay, tax bill. And he's going to also be subject to self-employment tax as well. So he might have another little, $10,000 tax bill on the self-employment tax for a total of $45,000 in taxes, right? So at the end of the day, this guy, after paying taxes, he's only left with $55,000 and no property, right? He's out. So he sold his asset and he had to pay Uncle Sam. That's what happens with the fix and flip guy. However, over here, the buy and hold guy, what's going to happen is the buy and hold guy, he's going to stick a tenant in there. And when you have a tenant, typically a seasoning period, maybe 6 months, but you're going to be able to cash out refinance this property. So on an appraisal of $300K, maybe you're able to take out 70%. So let's say he takes out 70%, $210,000. He's going to get all his money back for the purchase price and the rehab. And the best part is here, a loan is not a taxable event, right? Anytime you take out a loan or you refinance, it's not a taxable event. The government doesn't tax debt. And therefore, the buy and hold guy, he gets to not only keep his property, which is an income-producing asset, it's going to generate him equity, it's going to generate him appreciation, debt pay down, tax benefits, cash flow. We forgot cash flow, right? He gets to keep his property, and he doesn't incur a taxable event until he actually goes to sell the property, right? So that's the main difference between fix and flip and buy and hold. Fix and flippers get taxed a lot more than your buy and hold investor because they have income realization right away, rather than the buy and hold investor. they don't have a taxable event until they actually go to sell that property. Sure, they pick up rental income as the years go on, but that nest egg, that purchase price, the rehab costs, the appraisal, none of that is, that it's not getting taxed until that buy and hold ultimately goes to sell the property. So the next question is, my accountant reported my short-term rental on Schedule C, but I remember you and others mentioning that short-term rentals should be reported on Schedule E. Can you explain the difference and how this might impact me moving forward? Okay, awesome. Great question. So, again, we're going to have, now they might have done this correctly, okay? So short-term rentals can go on Schedule C. We don't see it quite often, and I'll explain a little bit why. So let's just do C and E, right? Schedule E, Schedule C. Now, 85 to 90% of short-term rentals are going to go on E, okay? And the reason being is when you have a short-term rental, okay, if you are not providing what are called substantial services, such as cooking, cleaning, taking the trash out while the guest is there, tour guide services, concierge services, if you're not providing substantial services, it goes on E, okay? No substantial services, it goes on Schedule E. If you are providing substantial services, such as those that I mentioned before, it goes on Schedule C, okay? That's the main difference here. If you are providing substantial services, it's going to go on Schedule C. If you are not, it's going to go on Schedule E. But what's the main difference? Like, why does this all matter? Well, Schedule E is where rental income and passive activities get reported, which means they're not subject to FICA tax, to FICA, which is Social Security and Medicare. So if you're a W-2 employee and you look at your pay stub, there's going to be a line item that says Social Security. There's going to be a line item that says Medicare. When you have rental income coming from properties, whether it's short-term rentals, long-term rentals, commercial buildings, it's passive income by nature, and therefore it's not subject to FICA tax, okay? So right away, by having it on Schedule E, you're saving 15.3% because you don't have to pay this FICA tax, okay? However, on the Schedule C, you are subject to FICA tax, are subject to FICA. And this is the big point here. If you're not supposed to be on Schedule C because you do not provide substantial services, you do not want your short-term rental listed on Schedule C, because in the event that you do have net income, which most short-term rentals do, right, because the cash flow is a lot better than long-term rentals, you're going to be paying extra taxes that you don't need to pay. Extra taxes paid. And that's the main difference. So if you are not providing substantial services, your short-term rental is going to go on Schedule E. If you are providing substantial services, your short-term rental is going to go on Schedule C. So the next question is, a friend of mine and I don't have the money on our own to buy our first property, so we want to pool our money together to buy a property. We are under the impression that we have a partnership. Can you explain what this means from a tax perspective, and what should we do to get on solid ground? Okay, so I'll say for the first part, to get on solid ground, you definitely want to make sure you have an operating agreement drafted up between you and that other person. Even if they're a friend or a family member, you want to have an operating agreement that outlines the good, the bad, the ugly, right? Who's bringing the money to the table? Are we both bringing money to the table? Who's in charge of managing the property? Who's in charge of managing the affairs? What happens if something goes wrong with that property? How do we split up? What if one person wants to sell it and one person wants to keep it, right? Everything that could go wrong, you want to have outlined in that operating agreement. That's more from a legal perspective, but let's get into a tax perspective. So when you own a property with somebody else, typically you'll have what's called a partnership. And a partnership is going to file, so we have partnership. The partnership owns the house, okay? The partnership is going to file a 1065 partnership tax return with the IRS, and it's going to issue K-1s to the investors. So you will get a K-1 and your friend will get a K-1 that reports your share of the earnings. Anytime you have a multi-member LLC or you own a property with somebody else, it's going to be a partnership for tax purposes. So you have an extra step here. You have to get this partnership tax return filed by March 15th every year. That's 1 month in advance of the individual tax deadline. So that gives everybody a month to receive that K-1 and then report it on their individual tax return. Once you receive this K-1, you will then report the K-1 on your 1040 individual income tax return. So first thing you want to do is get an operating agreement in place to outline the specifics, the good, the bad, the ugly, what goes wrong, what happens. And then you want to make sure that you're also getting cleaned up from a tax perspective as well. Make sure you're getting the necessary accounts like an EIN number. You're going to want to work with a tax advisor, an attorney, right? Make sure you're doing the things right the first time rather than having to go back. It's always better to start the race with your shoes tied properly rather than having them untied, right? The final question today that we're going to do is, can you explain how taxes work for people who house hack? Okay. So for those of you who don't know what house hacking is, it's essentially a term that's dubbed because you're going to typically buy a multifamily property, although I have seen people do it with single-family properties, single-family homes. But the idea is you're going to live in part of the unit or the house, and you're going to rent out the other portions with the goal being that the other portions, rent payments, you're going to have tenants or maybe you have friends or buddies. The other tenants are going to be helping you pay down your mortgage. I personally house hack, and I can tell you that it will reduce your living costs substantially. Instead of having a super high mortgage, you're able to have part of that paid down if you're willing to go that extra step and you're willing to kind of live below your means, not live with somebody else, but if you're open to buying a multifamily property. Another cool thing about house hacking, and I don't know if they changed the rule on this, but you're actually able to use part of the rental income that you get from the other units to help qualify you for the loan. And so I found that really interesting. I didn't know that at the time when I started doing it, but you're able to use part of the rent payment that you're projected to receive towards helping you qualifying for the loan. But let's get into the tax benefits. So the way taxes work for house hacking is that you're able to attribute a portion of any expense that you have either towards your personal use or rental use. So if I have, let's say a multifamily property, let's say I have a 2-story unit, okay? And let's just say for numbers' sake, they're both the same amount of square foot, okay? Well, if I have a property tax bill, right, I'm able to deduct half of that, right? I'm able to deduct half that's associated with the rental. I'm not able to deduct the portion that's available that I use for personal use because we're not able to deduct things that we use personally, but I'm able to deduct, again, a property tax bill, I can take half of that. Mortgage interest, I can take half of that. If I pay for water, I can take half of that. Most of the time, your multifamily units are going to be metered out, so typically the other person will pay their own electric and gas. But oftentimes, at least in my scenario, the water bill is one bill. The water and trash are on one bill, so I'm able to take half of that for my use, half of that for the tenant's use. But that's the important thing here is you're not able to deduct all the expenses that are associated with the property when you house hack. However, you are able to deduct a portion that's attributable to rental/business use. And you're going to report your share of the earnings. You're going to report your earnings on Schedule E of your 1040. So again, you're going to be able to take half of your mortgage interest, property tax bill. Now, if you have an expense that's just for the other unit, right? So let's say I have to replace the carpet in that rental unit. You're able to take the full amount if it's in that rental unit. Again, if I replace the carpet in my unit, I'm not able to take any expense. So those are the kind of the differences, what has to happen. I would say it's actually harder to do a tax return for somebody who house hacks than it is for somebody who doesn't, because then you have to worry about prorating or proportioning the rental use versus personal use. But that's how taxes work for people who house hack. That's going to be it for today, guys. We covered fix and flip, buy and hold, Schedule E versus Schedule C. We covered partnerships. We covered house hacking. Also, I will be hosting my first boot camp this fall that's centered around short-term rental tax. If you want information about it as well as early bird pricing, check out the link in the show notes below. And if you like this show, make sure you give me a review on Spotify and Apple Music. If you have any questions you'd like me to answer on the show, hit me up on Instagram or Twitter at LearnLikeACPA. Thanks for listening, and I'll see you in the next episode.